Stocks for beginners. Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
I firmly believe that the markets are efficient, but they have no imagination. And that's how we operate. Yet markets are very good, better calculator than you, me, or most market participants at working out the next 3 to 6 months. The market's incredibly efficient at pricing in what it thinks is going to happen quicker than you or any other market participant. But 6 to 12 months out, the market's got no clue. And 12, not that we have much of a clue, and 12 to 24 months out, the market's got no idea. The markets are efficient, but they have no imagination. So I think with small cap investing, you've got to focus on companies that can do things themselves, regardless of a GFC or a Trump trade war.
Hi, and welcome back to Stocks for Beginners. I'm Phil Muscatello. Which companies are the biggest little companies on the world stage? How does a background in anthropology help you to understand the behavioural side of investing? I'm joined today by Tobias Bucks from Ausbil. Hi, Toby.
Hi, Phil. G'day. How are you?
Good. G'day. And may I call you Toby?
Yeah, please.
Tobias is Portfolio Manager Global Small Caps at Ausbil. He's focused on global small cap companies, and his responsibilities at Ausbil include strategy and portfolio construction, research, analysis and portfolio management. Tobias has a Master of Arts with honours in social anthropology from the University of Edinburgh. So that's quite a turn from the humanities to funds management. Most probably more money in finance than the humanities, Toby, I'm assuming.
Yeah, that was a consideration, yeah.
So tell us about your journey from social anthropology to managing a fund. What was that like? How did that path take you?
Oh, I did always have a strong interest in capital markets and businesses. I'm not sure I'd really formed as a young man really what it was. And at school, I'd studied sciences through to the equivalent of HSC with a heavy focus on science and not much on arts. And one thing that really struck me about the syllabuses on offer at university was it was just more of the same. And I didn't really have any much interest in trying to learn more detail on a cell or more detail on more equations. I really wanted to learn how to think. And through a process of discovery, I started talking to people, and it seemed to me that I needed a subject that was really going to expand my horizons and help me grow. And social anthropology was clearly the one for me, and I still think it's a really underappreciated discipline that has a lot to offer everyone in their day-to-day lives.
So what did you study in your master's specifically? What was the particular subject?
So in social anthropology, we focus on culture and people as opposed to sort of medical or more forensic or historical anthropology. When you look at culture and people, there's various themes that are going on, and they're all interlinked. I have a particular interest in narrative and power and the theory of practice, which is key to being an anthropologist if one does want to be one. And that is what I've focused on. And that for me is still what I go back to and try and re-engage with the texts and the ideas to help me make sure I'm doing as well as I can at my day-to-day job.
So what in particular about social anthropology bears weight in the world of investing?
So I love that question, Phil. I'm super happy you've asked that because I wish people would ask that every day. What is anthropology? At the end of the day, social anthropology is an attempt to understand humans and understand ourselves. And that to understand oneself or humans, you need to understand the other, and you need to engage with the other as much as possible. So that's really what anthropology is about. It's about learning how to ask the right questions, because it's the questions that you ask that are in some ways more important than the answer that you get. And I know that sounds sort of silly and maybe a little bit like Douglas Adams, but that is the truth. If you learn to ask the right questions, you're going to get much more out of life. And that's what social anthropology teaches you. I got really lucky out of university. I did a degree in social anthropology and then got a job with Newton Investment Management in London, working for a guy called Paul Butler on their global desk. He's retired now, but a famous fund manager who very big in global equities, institutional fund management in the 80s and the 90s and the noughties, and well known, and he taught me a lot. I was very lucky to get that job. Obviously in London in 2005, there were a lot of capable graduates. And I think I just fortunately stood out. Right day, right time, right manager, and I ask the right questions instead of just parroting back what people think. And if you want to be good at investing, you've got to ask questions. Otherwise, you're just going to be a CFA analyst following the market around like an index tracker. You might have a few good years, but overall, you're losing money like gambling.
So when you say asking the questions, is asking questions of management or asking questions for an answer that you're looking for in the market and the numbers themselves?
Well, both, Phil. I think just going back, what can anthropology add to the markets? I think there's sort of two things or three things that are going on, really. The first one is anthropology has touched on, what are the markets? What are capital markets and why do they exist in culture? And what do they do for culture? And what does culture want from capital markets? I think that's a really good grounding if you want to start investing in markets, because these are all humans at the end of the day. And markets are purely a social construct. They're the most social construct. They're not real like the sun or like Mars. They're just a made-up cultural construct that we invented, around commodities and then around debt in companies and then around owning equity in companies. And to do that, I think there's a lot of anthropology that really helps, like Max Weber and the Protestant Work Ethic and the Spirit of Capitalism and the Iron Cage and Das Kapital by Marx and Engels. I think those are really important texts to understand what's important for humans. And then the bit probably people want to get into most of all, which is how can you improve yourself as a market operator? So social anthropology has some direct things for you. So, for example, focusing on power and self-bias, which I really focused on when I was there and something I've really tried to drag out now. There's a lot of work by French sociologists on the phenomenology of perception. There's a guy called Merleau-Ponty that I think people should read. And then there's a guy called Pierre Bourdieu who wrote an outline of the theory of practice, which was aimed at anthropologists, but it's just so important to equity markets or debt markets, because anyone who's worked in an investment market knows you have bias and you're concerned about your own bias. And this is an academic subject that's been going on for over 100 years. It will help remove your bias. And then it'll help you understand power and soft power. And that's really what it comes down to as an equity investor. I'm looking at earnings, the EPS results from companies, the earnings that companies deliver, and the expectations that investors have on the future earnings of those companies. And that is at its essence soft power. That's narrative. Nvidia trades on a huge multiple because it does well. It's got good financial results. That's real. In the future, we don't know what they're going to deliver. It's the soft power of Jensen. It's the way that they describe and explain a narrative of a future that makes people want to put a multiple on it. And it's the way companies say, my product's better than that company's product. They're creating a narrative around their product, a narrative around their company, their components, their services. And that's what they then go and try get other humans to value. So this is just a game of humans thinking with their imaginations. And so understanding that hard and soft power, how people create a narrative to be a niche leader or other things, is hugely important. There's other books, obviously, lots of books written on it that I think people should go and read. But I'd definitely start with Pierre Bourdieu and Maurice Merleau-Ponty.
What are the names of those books? Just so we can make a note and we'll put them in the episode notes and blog post as well. Yeah.
Maurice Merleau-Ponty wrote a book called The Phenomenology of Perception. I think that was around 1945. And Pierre Bourdieu wrote an outline of a theory of practice. I think it was in the late 70s. And those are the two books I suppose are most relevant for power and the phenomenology of perception. Like, who are you to perceive and what is that as a phenomenon and how do you deal with that? So it all sounds quite airy-fairy, but I'd say, well, look, company earnings, future earnings results and the multiples investors want to put on them, that's super airy-fairy as well. So we can build models and use calculators, but at the end of the day, our job is to guess who other people are going to think is the coolest company that's got the best upside in 2 years' time. There's a few steps of imagination and cultural interaction that go on in that.
Yeah, you mentioned Nvidia, and I have heard that about. Is it Jensen Huang, the name of their CEO?
Jensen Huang, yeah.
Yeah, and how he is setting up, he's talking about the future. It's not just about the company, it's about imagining the future. And is that how it relates in what you're saying in terms of the soft power that you're describing?
Yeah, hugely so. And I think it's really interesting the way he does it. Clearly they trade on a multiple because of him. And the same way you saw that with Musk and Tesla potentially. I think also soft power is important in just day-to-day stuff. Like, right, this podcast is going to go out in 2025. Everything's changing a lot. Trump came in. Things have changed. There's a war in the Ukraine. And people are trying to do different things. when you understand hard and soft power, you can ask the right sort of questions. So, for example, Starmer took a letter from the king to Trump, and Trump got all happy about it. Was that worth $20 billion in arms? Was it worth $40 billion in arms? Little known fact, but in 1963, the French lent the Mona Lisa to the Americans to improve French-US relations during the early Cold War. What's to stop the French, offering the Mona Lisa to the Americans to go around all the major art galleries in the US for another 3-month tour to improve relations, and potentially a 3-day stint in the Oval Office to start it off with, just to get some soft power on board. So there are a lot of things that are going on that I think asking the right questions helps you understand. Doesn't mean that you know the answers, just hopefully it expands and widens your sort of field of understanding and helps you focus on what's really important, I think.
We will get to the fund and specific investing questions, but this is so fascinating. You talked about, I think it was social construct, that markets are a construction of humans. But money is as well, really, isn't it? I mean, we ascribe a value to something just because we believe it has value, nothing else. I mean, I know nothing about Bitcoin, for example, but I think, well, humans are ascribing a value to it, so it must have a value. Same as gold, same as money.
Yeah. It's a really interesting subject, the fiat currency and its store of wealth. Humans have been trading rights and future responsibilities, all kinds of rights, rights to eat, rights to reproduce, rights to stay in a location, rights to engage in a ritual. Humans have been trading rights and bartering rights and bartering food for as long as, probably before when we got fire. And it's only in the last sort of 3,000 years that we've started using money. But there was other things in form of money. Obviously, the Romans used salt, and there were a few other things. But that trading of things hasn't really changed. What's changed with money, I think, is really interesting as Marcel Mauss calls out in The Gift, which is, and Engels and Marx are calling out, which is we used to exchange things to improve social relationships. But now we buy things for consumption. We don't care about the relationships. And that's a reason why society is breaking down. Even worse than that, people point to the fact that now on social media, now there is not even a real life social relationship that's being built with this activity. It's just poof into thin air. There's no actual real trustworthy relationship that you can sort of rely on if you get into trouble or you need help. So it's an interesting area, that money thing. But it's the greed and the rights that humans are after. And humans are mostly trying to improve the position for their offspring and their own happiness day to day. I mean, that's their number one aim. And money has just enabled people to do that in a way that's not great. 1,000 years ago, you couldn't have a rich person just living on their own with their money. They'd have to support villages of people, look after the sick, they'd have to educate. There was a responsibility that came with those rights. Now it's a lot of rights without the responsibility, and that's what the money invention as a social construct's done. But it also gives an opportunity for people to improve the lives for their offspring by investing. So I don't ever take an ethical stance on it. I think investing's really good. We need to build companies. We need to make new drugs to solve and fix horrible diseases. We need to improve the lives of, the 8 billion people in the world, and we need to end war, etc. So we do need stock markets to help facilitate that.
Investing in shares can be fun, but the paperwork isn't. My investing's been transformed since using ShareSite, the best portfolio tracking tool for investing. My portfolios are on ShareSite, and whenever I buy or sell, the trades are automatically recorded. I can see the dividends I'm receiving, and it helps me to work out my asset allocation. ShareSite are extending a special offer to listeners of this podcast, 4 months free on an annual premium plan. There's a 7-day free trial where you can experience the full power of ShareSite portfolio management. Go to sharesite.com/shares for beginners and sign up now for a free trial before taking advantage of 4 free months. That's sharesite.com/shares for beginners. We've got to do another episode, just simply talking about this. But let's get on. Yeah, no, I would really love to do that as well.
We'll do it.
So let's compare Aussie small caps and international small caps. What's the difference in size and scale and also scope of operations? Because as we all know, there's so much mining in the small cap space in Australia. Just to try and give us a feel for the major differences when you're moving up into international small caps.
So the jargon and the lexicon's deliberately misleading, unfortunately, because of the way it's all been set up. But very, very briefly, small caps, as I think is generally understood in Australia, are businesses that are listed outside the ASX 200. They're the not 200 companies, biggest companies in Australia. It's a similar way of working things out in the rest of the world. Put simply, global small caps, they're companies that are listed outside of Australia on developed market exchanges with the size somewhere between the ASX 50 down to the bottom of the ASX 200. So we call them small caps because they're smaller than Nvidia and Bank of America in America, but they're still serious companies. So just for Aussie investors, when we say global small caps, we're usually investing around the size of REA. Okay, so just outside that 50, ASX 50. That's what a global small caps are. So 500 million market cap up to about $20 billion market cap.
And also, what about the scope of operations? I notice the largest sector weighting is in industrials. What kind of industrials, for example, are included in your funds?
So it's a huge scope, and we're core investors, and we invest in everything from people who mine, people who provide technology, to software and financial services. Global small caps as compared to domestic Australian small caps is far less mining. Australian, as you pointed out, is a lot of mining and mining services and materials. Globally, there's a broad range, much more broader range, and it includes every industry in the world. Obviously, we don't have a lot of manufacturing here, so in Australia, but outside of the world, there's a huge amount of manufacturing and IT. Very broadly, around 22% of the world index is in industrials, as you mentioned, and that's a really miscellaneous sector. It's everything from heavy transport to construction to business services. It's pretty much every business that doesn't fit easily in the other sectors of, what we traditionally call telecoms. We got discretionary, so both consumer discretionary, and consumer staples like grocers, financials, healthcare, industrials, IT and materials and real estate. The biggest differences would be in IT. For our fund, investing in global small caps gives investors exposure to many more different types of businesses in hardware and software, far more superior than you can get in Australia. Industrials as a manufacturing offering isn't huge in Australia. So investing in manufacturing, we can take part in businesses that are exposed to components in the power grid, components that are needed for the defense industry, components that are needed for other things that we're trying to do in the world. That's a great offering. We have a lot more opportunity to invest in healthcare and financials than we do in Australia. So I'd say key points are it's broader and you get opportunity to add to everything. There's 4,500 stocks in our universe. So that compares to around sort of 400 if you're an Australian small cap investor. So a far superior opportunity set. And what's great about that is it means there's always a bull market somewhere in global small caps. And you don't have that investing in other areas. Because we can invest in all developed markets in the world, whether it's Japan, Singapore, Sweden, Switzerland, the US or Australia, and we can invest in every single sector, whether it's hardware, software, healthcare, staples, whatever sector or business, there's always a bull market for us somewhere to invest. And that's what really sets apart the asset class and why I think people should be allocating more dollars to it on an ongoing basis.
In the Australian small cap space, it's often said that you can have an advantage because there's far less research and far fewer brokerage houses that are researching these companies. Is it similar on the global stage as well? Are there less eyes on this sector?
Very much, Phil. In fact, it's better overseas than it is in Australia. Australia does have a slightly inefficient market, as you've pointed out. Overseas, we've had changes in regulation in financial services industry in Europe and the US. It's called MiFID in Europe, and there's another one in the US. And essentially that changes the way people pay for services. What it's done is meant far less sell-side broker research on global small cap companies. So for a company like REA, where you've got between 8 and 10 analysts covering it, maybe more. The equivalent size company in the US, you've got 1 to 2 analysts covering it. So it's got more inefficient.
So the investment style of the fund is described as unrecognised growth. Does this give you a bit of help in terms of recognising what other people aren't recognising in a company and what their potential might be?
I hope so. Simon Wood and myself have worked together for coming up. We first started working together 18 years ago. We have our process that we've been running in the UK, and we've run it here in Australia 7 years now, focusing on unrecognised growth. I think it does give us an advantage. We're a quality manager. We're trying to buy the companies that become the next Amazon, that become the next Netflix. In this fund at Ausbil, we've bought and held successfully The Trade Desk, Capcom, and Vertiv, and a few other names that have gone from small caps to being mid caps. We want to own the growing companies. You've got to do it with a focus on valuation. Valuation's really important for investing. It's an incredibly important discipline. You make all your money the day you buy something because you never know when you're going to have to sell it. But having too much for focus on valuation in small caps can be dangerous because you just focus on companies that are cheap. And cheap companies are usually the ones that aren't growing. So just having a valuation focus, you can see over the last 25 years, all the value managers and global small caps have produced bad returns. They've underperformed the index consistently, and it's not a place that people have wanted to put money. And I would suggest that would be right, because if you focus, you're in a growth asset class and you focus on the cheap stuff, you're going to miss out on Amazon, you're going to miss out on the Trade Desk, you're going to miss out on MCore, you're going to miss out on Vertiv, you're going to miss out on all the good stuff. Having said that, if you just focus on buying the companies that are growing the most, which other funds do, it looks great for a few years, and then you run into sort of a period we've had in 2025 or 2022, and the funds blow themselves up, right? They're down 40, 50%, and their clients are upset, right? So both those extremes don't make a lot of sense to us. So we've seen people blow up left, right, and centre, and clients go unhappy. What's delivered our strong returns in Europe when we're at Barings, and our strong returns here, is having a real focus on the growth and buying the growthy companies, but just overlaying a very, very strong price discipline. And that's basically what unrecognised growth is. A lot of investors look for companies to have positive surprises on their forward guidance. I mean, that's well known. It drives earnings estimates. But making sure that you're always cheaper than the index is lost. So with focus on unrecognised growth is our way of saying, yeah, it's cheap growth and it's a surprise and it's quality. Therefore, you need to buy it. And that's what we've always focused on.
Can you give us an example of a company that in your portfolio that you're very excited about? I know listeners do love to hear about individual company stories.
There's 76 stocks in the portfolio, and I'm super excited about all of them. I'm also excited about stocks that we don't hold in the portfolio that are on our buy list that I think have got a lot of good upside. So there's a lot of opportunity out there, and there's always a bull market somewhere in global small caps. Can be volatile. This is a podcast, so we don't know exactly when it's going to go out, but Trump's come in and he's with a lot of volatility, and that's
We're not talking about volatility because it's just changing day to day, as we know overnight in markets, but we're not going to go there.
So, things can change in the short term. The markets are, this is my tagline, and I sort of came it up as well as there's a bull market somewhere in global small caps. I firmly believe that the markets are efficient, but they have no imagination. And that's how we operate. Yet markets are very good, better calculated than you, me, or most market participants at working out the next 3 to 6 months. The market's incredibly efficient at pricing in what it thinks is going to happen quicker than you or any other market participant. But 6 to 12 months out, the market's got no clue. And 12, not that we have much of a clue, and 12 to 24 months out, the market's got no idea. The markets are efficient, but they have no imagination. So I think with small cap investing, you've got to focus on companies that can do things themselves, regardless of a GFC or a Trump trade war. They need the balance sheet to go through the sticky times, and they need the products or the services that are leading that they can take to more places geographically, and they need to put the balance sheet to work, improving their vertical integration and other parts of the capital structure. So we got lots of different companies that do that, and that's what I really want to see. If that's a great management team at a cheap price, and I think the end industry demand's misunderstood by the market, then that makes me super excited. So that's what forms the basis of all our picks. the investments that we make, and we trim and add to those as the prices move around. Right now we got a lot. I think there's a lot of opportunity in the market because market's down sort of 20% since the start of the year. See, depends on what day you are, that score, but less than the NASDAQ. So global small caps have outperformed the NASDAQ considerably. So your S&P, Mag 7, NASDAQ investments will have underperformed significantly this calendar year. That sets up a lot of opportunities for investors across the NASDAQ, the S&P, and global small caps, particularly in global small caps, as businesses that have been really underappreciated for many, many years because people have just put money into passive and very little money's gone into active. And that active money's all gone into the US pretty much, or on a relative basis. And it's all gone onto these rubbish software stocks, which I just do not believe in. I mean, the bull case for software stocks has to be the worst investment case I've ever heard right now. And no one's been putting money into Europe. No one's bought European companies for 20 years. The valuations are stupid. So in the end of last year, the end of 2024, Simon and I, after 2 very strong years, Simon and I sold a lot of our US holdings and started buying Europe on the basis that we didn't think Europe could get any worse. It was cheap. And the US was just stupid expensive, like ridiculously expensive at the end of 22 in some areas of the market. We weren't in them, but large caps, Mag 7 to be a standout. Right now, I think there's a lot of opportunity in the power grid. I think before we get down onto the actual company specifics, just taking a bigger step back, if there is a recession or if there is an improvement in growth, what's still going to be there? And the investment in the power grid's huge. So we all know we need to change our generation. We need less coal and we need more wind and solar. Up for debate how we do it, but that's roughly it. And we need to change our distribution because everyone wants to get home on a Friday night and be able to plug in an EV and fully charge it and turn on all their home electronics and the air conditioning. So we got to rebuild the entire grid, really undercooked. The build out of the grid is built on peak demand. So it's all built on you going to be charging your cars, EVs, and more importantly than that, the air conditioning, the heating or the cooling in your house. It's got nothing to do with average load demand, which is sort of data centers and AI growth is sort of suggested to drive it. So this year, with the concern around AI maybe getting cheaper or growth rates not being increased this year, with DeepSeek, people got concerned about power demand going forward. And DeepSeek and AI, it's got everything to do with average load, but nothing to do with the peak load because data centers are counter-cyclical. So I think the market's got the power grid wrong. I think that's the best place to invest globally, that and defense over the next 2 years. Defense is an expensive sector, lots of good little companies. The power grid names are extremely cheap. What's great about the electrical grid is they're key components that you can't develop a new technology for some pieces of equipment. We perfected the technology 100 years ago. We're just changing the design and the materials now. So, and there's very strong regulation protecting how you can provide a product to the electricity grid. Obviously, not anyone can say they've made a product. It has to be tried and tested and known about for years and past regulations. So that setup's there for the electricity grid. It's setup's there in Europe and it's setup's there in America. If you speak to people, we need transformers and switchgear. That's a long conversation, but we need a lot of transformers and we need a lot of switchgear. And we need it everywhere on all stages of the grid, from generation through to transmission and then distribution. And the rebuild of the US will require more. And they don't make any transformers in the US. So the US is the biggest market for transformers in the world. Only 5% of transformers get made there. And the US is a custom transformer market, i.e. it's not standardized. And I can get into why that is, but we'd need 2 podcasts. So it's a very high margin business, got huge demand, very high barriers to entry, and there's very few players. So there's a business called Hammond Power Solutions that's listed in Canada. It's been a top 5 position in the fund for almost 2.5 years now. The share price is off its high, but we think that over the next 5 years, they're going to continue to expand their manufacturing base and grow margins. And if there's a recession, on a relative basis, that's going to be even better. Obviously, on an absolute basis, quite bad. So Hammond Power Solutions is trading on 8 times EV/EBITDA and it's net cash. And it's the only listed transformer company in the world. So I'd really look at transformers, and then switchgear is another area that you just can't make the stuff. The same setup exists, and we need a huge rebuild. In switchgear, we get different types. We get the big metal switch that you see people sort of lift up for Frankenstein, to recharge Frankenstein. But modern days, we have smaller versions of that handle more power. And also we use basically spark resistant switchgear. So you build the switchgear in a box and you make it almost a vacuum with inert gas. And that's important for energy facilities or near manufacturing facilities. Electrical fires are really dangerous. They're really powerful and they can be hard to extinguish. And there's a lot of money that needs to be spent on the grid. And if you muck up any small bit of planning, you could blow out all these other really expensive components. So you don't muck around when it comes to getting the right component. You overspend, because the risk is just too much. So I really think there's excitement there. And there's one listed company in the US that makes switchgear. They produce for themselves and they sell to the OEMs, and it's called Powell Industries. It's a Texan company, and that's been in the fund. So those are two companies that I think are going to do well. And then the last one, probably worth mentioning on the grid as well, there's a Danish company called NKT. There's basically 3 companies in the Western world that can make transmission cables. They make medium voltage and high voltage and low voltage cables. There's Nexans in France. NKT is almost 100% high voltage. So we're talking 525,000 kilovolts. The big transmission lines that are going in. It's very difficult to make new facilities to make these high voltage lines. You need to build a building that's sort of 200 meters up and 100 meters below ground called an extrusion tower. It takes about 3 or 4 years to get one of these things built. You have to wind these high voltage cables on the fly. So they start being wound at the top. You get the copper, the nylon, the protection sheath, and it all gets wound on the way down, and the cable gets made on the fly. That's how you can make kilometers of it. They've been investing heavily in new facilities for the last 4 years, and they're starting to reap the rewards from that. The market, the global installed transmission line base is around 40 million kilometers at the moment. And the world thinks they're going to go to 80 million kilometers by 2040. I think they're going to go to 60 million kilometers by 2030. There's no way the industry can produce that much cable. So then it's not going to get installed. And the net result is that countries that want their electricity grid upgraded this decade, not next decade, are overpaying, or they're paying up front for this stuff to be installed. So there's a massive supply-demand imbalance in high voltage cables as well, and it's skewed very much in favor of NKT. Business is cheap. It's trading on, I think, right now, I think it's on 13.5 times forward this December. So I think there you've got a business that I think over the next 10 years is going to do extremely well. By then, I think it'll be a decent mid-cap, and I think everyone will be very happy. I certainly am expecting very high returns over the next 5 years for their manufacturing assets. So those are sort of 3 businesses in different parts of the world, slightly different products, all industrials, but 40% of the fund's in industrials at the moment. But I think they're businesses that they're going to go well over the next sort of 3 to 5 years, regardless of whether this tariff war turns into a massive recession or whether there's a Cold War between China or America. And if anything, the worse the tariff war gets, the better it is for the electrical grid, because whilst the tariffs might be bad for global trade, they are good for net growth in square foot manufacturing base in the US. It's been growing rapidly over the last 5 years and is expected to grow even more so. So I think all those things mean that I'm pretty happy with calling out those names doing well.
That sounds like quite a tailwind for the power sector. And, and you're also pointing out that there are many other analysts who you seem to think that are getting this wrong. I think you wanted to mention something about having some humility about your own investment decisions. Is that right?
I would love to. I firmly believe that the universe, hates hypocrisy, loves irony. And I think that's probably a decent way one should try and improve oneself a little bit. Getting 60% of your stuff right is good enough to have a very good track record as a fund manager, as long as you do the right things at the right time. Having a higher hit rate than that's even better. Trying to understand where you're wrong is hard. It's a lot easier if you've got lots of other people pointing out different ideas and different views. So like coming back to anthropology, I think, yeah, it's good to be able to analyze your own views, but at the same time, you're so biased and conflicted that can you really look in front of a mirror and deliver any good in a 5-minute conversation with yourself? Because you're just internalizing personal views. Checking the other view and analyzing it and maybe attacking it, I think is a lot easier than attacking your own view. So one things I've always tried to do is instead of just trying to rip yourself apart, which is what you should do to be, completely balanced, what your balance of scales are, what you think's on the lift and what's on the drag side. So you can balance that. But you can't rely on it. You've got to go to the other and see what they're doing. It's very much easier to try and put yourself in the other's shoes, try and be positive, find out why you agree with them, and then try and rip them to shreds. Because if you do that enough, what's going to happen is you're going to rip your own argument to shreds, and you're also going to give more support to the things in your argument that are actually right. So the first point, I think, on humility, clearly we're all wrong, most of the time. And finding out how you're wrong is actually pretty difficult. Like, you got to have the humility. I think one should try and have the humility for one to admit that one can't solve it on one's own. So this whole I'm going to try and be humble, or I'm going to try and be balanced and lose my bias, I think anthropology would tell you you're on a losing game. What it would say is, look, you're biased. Sorry. The best thing you can do is shut up, get out a notepad, sit down, wear what the other person's wearing, to do what the other person's doing, eat the food the other person's eating, and just ask questions and write down the response, because you're going to learn a lot more doing that than you are trying to investigate yourself and your own history. And so I think on the power grid, when you read what's going on, there's a need to change. So they're very clearly telling you culturally, Europe's telling you, they believe that wind farms and solar panels are just as important as tanks and missile factories. They're telling you that. I mean, Europe's been through a hell of a lot. They relied on the Chinese market for trade, the Russians for energy, and the US for security. And they've lost it all in a year and a half. They've got to have a complete rethink. So culturally, that's super important. So therefore, it's going to take precedence over migration. It's going to take precedence over tax reform. It's going to take precedence over all these things. Therefore, when you read through the government bodies that are set up to deal with it, so there's legislation been put through in Europe now that all the states have to correspond to. It's all written there and it's all planned by the regulatory bodies. So then you can map out on a global basis, and we did this. At Ausbil, what we try to get the macro right, then we deep dive into sectors or regions, then we deep dive into stocks, and then we try and optimize the portfolio for our best ideas. Done a big deep dive into the energy grid, and I read a lot of the plans from the transmission operators, and I put it all together. We did as a team, and we have an idea. We think there's going to be 80 million kilometre lines needed. We know 60 by 2030. We think they're going to deliver barely 55. So we've got an idea of where we think the opportunities are. Then when you go and read somebody else's piece of work, most people are reading or basing the ideas on, and it doesn't contain a single reference to those papers anywhere, it's hard to assume they've read them. And then when they talk about the business in such a recent basis, so they just talk about the last 6 months to a year, and then you see that they've only been covering industrials for 5 years, and that they've only been in the market 9 years, and they were never around in the GFC. They weren't managing money in the GFC. They don't understand what a GFC trough valuation looks like. You can start to see where their sand is wet and soft, and their foundations are just moving all over the place. There's no build for it. So they can't have the humility to admit they're wrong, because they don't have the humility to admit they haven't read the papers. So, and then when I know the businesses, I know they're wrong. I could be getting some of my things wrong, but I know that the theory of what they're putting together is not right. Therefore, it's going to fall apart. Mine could fall apart just as easily. I think on the grid, people are really missing the sort of 5 years of big transmission and then the distribution comes. I haven't seen many people speaking to grid engineers or actually taking the time to go and visit the component manufacturers. And if you go and visit these guys that are making these components, they'll tell you where to look. So, you can visit the guys in the small cap world, and then you can see the large cap Siemens Energy, who has to buy this stuff off. The OEMs have to buy this stuff off the small guys. They don't produce it themselves. And they can put their margins up by 400 points. You can go back to your model and put your margins up by 600 points. So there's a lot of opportunity in the grid that's not being respected. I think people are too easy to focus on defense or the end of US exceptionalism, which, everyone coming on your show 4 months ago would have been talking about US exceptionalism and how Europe's totally screwed forever, right? So I think power grid's the most exciting area you can be in right now. Up to that, I think the rebuild of Europe's really underappreciated. They don't have to do much.
So in the sectors that you're looking at, what are the main risks and how do you manage them?
There's risks everywhere. I think some of the main risks are in equities are going to be, your first one's your drawdown risk. So do you own a good business but over a bad period? So, own a great business like Mueller Industries, one of our top holding, but you hold it during the GFC, that's a risk. So there's timing risk to these assets. And then there's a business performance and then there's a liquidity risk. Liquidity risk is the easiest one to deal with. There is more liquidity risk in small caps than large caps. You get paid a premium for that. And the market's liquid. I mean, you are going to get your money back. It's not like all the money everyone's been putting in private equity, which, the flags should be massively being waved. People should already be asking for their money back. It's liquid, but, you could have some price pressure on the way in, on the way out. How do we manage it? We liquidity weight all our positions. So we think liquidity risk is lopsided. We don't want to gain from it that much. We don't want to suffer from it. So our big stocks are liquid. They've been in the fund a long time. New ideas that are smaller in size as a company are smaller positions in the portfolio. Then,
when you're referring, if I can interrupt for a moment, when you're referring to liquidity, does that mean the amount of money that's moving around in the markets in and out of that particular company? Is that a fair description?
Yeah. Exactly. So in terms of US dollars, most of our companies trade between 5 to 50 million US dollars a day. That's incredibly liquid. That's much more liquid than domestic small cap funds. It puts us about the same liquidity. Our stocks are as liquid as Australian large cap funds, but we traditionally get sort of 3 to 4% annual premium return over domestic equities historically. And so, there are liquid, it's easy to get your money in and out. And I think that's really important for investors. There hasn't been a liquidity issue in markets, really, a bit of the yen carry trade last year, but there hasn't been a liquidity issue since the GFC. I think people have forgotten to price in liquidity as a risk. When a fire sale commences and the exit is small, there is a lot of trampling at the exit. So
so that's when liquidity is leaving the market. It's just like basically everyone wants to sell, get it out, put their money in gold bars and put them underneath the bed.
And it's dangerous. So we are a listed fund in the sense that all our assets are daily traded in huge volume. Some way towards that probably will happen over the next 1 to 10 years because you tend to get big events. Liquidity is really important to make sure you're on top of, and we focus on it strongly. Then business risk, in terms of the actual businesses that we analyze, we're focused very much on trying to weigh the scales. There is a story out there, put out there by management. There's an understanding of that story by the market, and evaluation's been given to the paper. We really think about the scales on each division. We look at their margins, what's more likely to go up or down, and what's been priced in. Over time, I think we developed a good process to benefit from that risk, and our returns have showed that we do benefit from that risk. That's good. And then the main risk for investing in markets is, do you hold it during a period where there's something really bad happens? It's not the timing of the market, it's timing in the market that gives you your returns, that old mantra. There's not a lot anyone can do about that. Our way is to say, and what I do is I dollar cost average. I want to put a certain amount of my dollars into global small caps and a certain amount into gold, or basically cash. Global small caps has historically provided the best risk return in the asset class in equities, and also the best absolute return. So I'm fully about it, but I put in a set amount of money. Everything else goes on my children. If there's a time in the market where you think the market's really expensive, you could not put in as much as you normally put in every month. And likewise, if there's a time where you think the market's very cheap, you should put in slightly more. Hopefully, at the extremes of the GFC or the tops of last year in the US market, people were doing that correctly. No one can do it perfectly. But that just means that you got a bit of powder dry. You're not always picking stuff up at the top, and you definitely are picking up some stuff at the bottom. And that's the best approach to manage that risk. our job's to be fully invested in global small caps. People who put money in our fund expect it to be fully invested in the asset class. They don't expect us to have a sort of waiting in cash. They can put money in cash and gold themselves. So my advice to people on that is to get some good financial advice on what's right for you.
So if people want to, and viewers and listeners want to find out more, and this fund is available, you can, like if you've got a wrap account, like a BT Panorama, this is available for ordinary investors that way. You don't have to go and buy units in this fund directly from MFund, do you?
No, it's right there. And later, Ausbil in the future will be producing active ETFs, so hopefully that's the journey we're going on, which will also provide another avenue for people to invest in it.
And how can listeners and viewers find out more?
Well, the best thing to do is to speak to your financial advisor about Ausbil Investment Management, or go to ausbil.com.au and have a look.
Tobias Bucks, what a conversation. We're definitely going to get you back on to talk about anthropology, and it seems to be even going into economics and philosophy there as well. So thank you so much for joining me today. It's been a great pleasure chatting with you.
Phil, that was a great pleasure. I wish we had more time. Yeah, I'd love to talk more about anthropology and stock markets. I don't know any other fund managers that I've ever met in the industry with a social anthropology degree. I think it is far more useful than going and getting an accountant or an economics degree. If you want to go into funds management, you are going to have to get your CFA later. The maths is super easy, but no one's going to teach you how to ask the right questions or get you to ask yourself, what questions do you want to ask yourself?
Thank you very much.
Thanks, Phil.
Thanks for listening to Stocks for Beginners. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.